You've probably seen the headlines by now. Canada versus China, trade retaliation, tariffs are back. Some channels are already calling this the opening shot of a new global trade war. Others are framing it as a quiet win for North American supply chains, and a few are stretching it into an outright bullish case for commodities across the board. If you're feeling like the noise level jumped straight to 11 overnight, you're not alone. That's exactly why I wanted to cover this topic today. Not to amplify the drama, but to slow it down, walk through the actual numbers, and separate what changed from what didn't. This is Financial Briefing. My goal here is clarity, not clicks. Over the next half hour, we're going to unpack the 6% tariff decision that caught most people off guard, look at how real markets are responding, and talk honestly about what this does and does not mean for metals, trade flows, and positioning. No hype, just context. Before we get into the data, I want to do a quick scorecard because accountability matters. Back in late February, when silver was trading around $31, we said that a breakout above $32.50 would likely stall unless industrial demand improved. Silver pushed to 33 briefly, failed to hold, and spent the next 3 weeks chopping sideways. That call wasn't perfect on timing, but the range held. In early March, we also said that tariff rhetoric coming out of North America would likely be more targeted than broad, with limited immediate inflation impact. At the time, some channels were calling for blanket tariffs within weeks. What we got instead were narrow measures, delayed implementation, and carve-outs. That framework held. And finally, in April, we said that China would respond more with administrative pressure than headline-grabbing retaliation, at least initially. So far, that's been accurate. No sweeping counter tariffs yet, just regulatory signals and selective pressure points. We don't get everything right, and when we miss, we'll say it. But the process matters more than the prediction. Now let's talk about what actually happened here. The first data point is the tariff itself. Canada announced a 6% import tariff on a defined set of Chinese origin manufactured inputs, primarily tied to energy infrastructure, specialty steel products, and select industrial components. This is not a blanket tariff. It affects roughly 12 to 14 billion Canadian dollars in annual imports, which is about 3% of Canada's total imports from China. For context, during the 2018 to 2019 trade tensions, Canada's effective tariff exposure to China peaked closer to 10% of bilateral trade value, so this is meaningfully smaller. What it means is that Canada is signaling alignment with broader Western supply chain policy without fully escalating. It's a nudge, not a shove. It also suggests political pressure domestically to be seen doing something without risking inflation backlash. What it does not mean is that Canada is decoupling from China. Trade volumes are still near all-time highs, and exemptions remain wide. This is not a regime shift, it's a calibrated move. The second data point is China's response, or more accurately, the lack of an immediate one. As of now, there is no formal retaliatory tariff announced. Instead, we've seen language around reviewing Canadian agricultural and resource imports, and a subtle tightening of inspection standards. Historically, when China plans a serious response, you see it within days. In 2020, barley, restrictions came within 72 hours. This time, we're 2 weeks in, and it's still procedural. What this means is that China is weighing the cost-benefit carefully. Canada is not the primary target. The signal is likely meant for Washington and Brussels, more than Ottawa. What it doesn't mean is that China is backing down. Administrative tools can be just as effective, and they don't show up in headlines the same way tariffs do. The third data point is market reaction, specifically in metals. Silver was trading around $32.80 when the news broke. Within 48 hours, it moved to roughly $33.60 before giving back half that move. Volume was elevated, but not extreme. If this were a structural shock, you'd expect sustained follow-through. Instead, we saw a classic headline pop followed by digestion. For comparison, during the 2022 energy trade disruptions, silver moved nearly 8% in a week and held those gains. This move was about 2.5% peak to trough. What it means is that markets noticed, but they didn't panic. This was filed as a marginal positive for industrial metals, not a game changer. What it doesn't mean is that silver demand just structurally increased. Fabrication demand forecasts haven't changed meaningfully based on this alone. Now let's talk through the bullish case, because there is one, and it deserves to be taken seriously. First, tariffs, even small ones, reinforce the trend toward regionalization. Over time, that tends to favor higher cost but more stable supply chains, which are metal intensive. Silver, copper, and specialty alloys all benefit at the margin. Second, this move adds friction. Friction raises costs. In an environment where inflation is already sticky, even incremental cost pressure can revive interest in hard assets as hedges. Third, this fits into a broader pattern of Western economies quietly tightening trade policy while avoiding overt escalation. That kind of slow grind can be supportive for commodities without triggering demand destruction. Fourth, if China responds asymmetrically by restricting certain exports, industrial metals could see temporary supply constraints. Put together, I'd assign about a 25% probability to a scenario where this decision contributes to a sustained bid under silver, pushing spot toward the $35 level over the next 2 to 3 months, assuming no major demand shock. Now, the bear case, which in my view is just as important. First, the tariff scope is limited. 3% of bilateral trade is not enough to move global supply chains on its own. Second, exemptions matter. Many of the most metal-intensive categories are excluded or delayed. Third, global growth data remains mixed. Manufacturing PMIs are still hovering near contraction in multiple regions. Tariffs don't help demand. Fourth, markets have become desensitized to trade headlines. Without follow-through, these stories fade fast. In this scenario, the tariff becomes background noise. Silver drifts back into its existing range between 30 and 33, and attention shifts back to rates and the dollar. I put that probability around 30%. The middle case, and this is where I land, is less dramatic. The most likely outcome is that this tariff decision adds a small but persistent layer of geopolitical risk premium. It doesn't drive a breakout on its own, but it helps explain why dips are getting bought faster than they used to. Silver stays supported above 31, tests 34 on good data, and frustrates both bulls and bears with sideways volatility. China continues to signal displeasure without escalation. Canada maintains the tariff, and nothing explodes. I'd put this scenario at roughly 45% probability. And to put this in historical context, the closest comparison isn't the 2018 trade war. It's the 2010 to 2012 period of managed friction, when countries introduced targeted trade measures under the guise of standards, safety, and national interest. Back then, metals saw episodic rallies, not parabolic moves. Silver rose, but in fits and starts, driven more by monetary policy than trade alone. The similarity is the incrementalism. The difference is today's debt levels and tighter monetary conditions. That limits upside, but also limits policymakers' willingness to shock the system. Looking across markets helps ground this. Gold is trading around $23.50, up modestly, but not breaking out. That tells me fear is contained. The dollar index is sitting near 104, stable. No flight to safety, no collapse. The 10-year yield is hovering around 4.3%. Rates are restrictive, but not spiking. Together, these signals suggest a market that is cautious, not alarmed. Trade friction is a factor, not the factor. Positioning supports, that read. COT data shows managed money net long silver, but not crowded. We're around 35,000 contracts net long, compared to over 70,000 at previous peaks. Banks remain net short, but within historical norms. There's no sign of forced covering. Institutional flows into metals ETFs have been modest, not euphoric. That's important. This is not a FOMO environment. So what am I doing with this? Here's my framework, and remember, this is not advice, just how I'm thinking about it. If silver breaks and holds above 34 on volume, I add incrementally, targeting a move toward 36, with a stop below 32.50. If silver drops below 31 on macro weakness, I reduce exposure and wait. No hero trades. Right now, my allocation is roughly 40% precious metals, split 2/3 gold, 1/3 silver, 20% cash, 20% equities, 20% alternatives. My stop loss on new silver adds would be about 7% below entry. Take profit would be partial at 36. Reassess from there. What I'm not doing is just as important. I'm not panic buying because of a headline. I'm not doom scrolling trade war content designed to scare me into bad decisions. And I'm not assuming that every tariff equals systemic collapse. History doesn't support that. For the coming week, here's what I'm watching. First, any formal response from China. A tariff announcement would be bearish risk assets. Short-term bullish metals. Silence keeps us range-bound. Second, Canadian inflation data. If tariffs show up in CPI unexpectedly, metals could catch a bid. If not, this fades. Third, U.S. yield movement. A break above 4.5 on the 10-year would pressure silver regardless of trade news. To wrap this up, here are the key takeaways. This tariff is targeted, not transformational. Markets noticed, but didn't panic. Silver has support, but not a clear catalyst. Patience beats prediction here. If you value this kind of calm, data-driven breakdown, consider subscribing. It helps the channel, and it keeps this conversation grounded. I'm Financial Briefing. Thanks for spending your time with me. Stay sharp.